Let's discuss what it all means for the economy and the Fed with JPMorgan chief U.S. economist Mike Feroli. Mike, is that the end of the soft landing story?
Well, I think over the past year, we and other forecasters have been kind of bouncing between soft landing or mild recession, and certainly the latest tightening in financial conditions, not just higher interest rates and higher mortgage rates, but weaker equities, a stronger dollar, which you mentioned earlier. All those are certainly raising the risk that we may be leaning a little more toward the mild recession rather than the soft landing.
Do you think the Fed is going to keep raising rates?
No, we think they're done here. And I think what we've seen in markets lately probably reinforces our conviction in that even if we do get some better data between now and the early November meeting, we think they've probably seen enough damage here, or implied damage from financial conditions to the broader economy, that they're going to be comfortable, we believe, on hold for the rest of the year.
So housing is getting hit. We mentioned mortgage applications. How much worse do you think it's going to get in that sector? And how do you look at the spillover in other sectors, too?
Yeah, so right now, home sales are basically at rock bottom levels. I mean, there's always some underlying demand for resales, even at very high mortgage rates. I think what's interesting is that you haven't seen a similar hit to home building. And I wouldn't expect that to come down dramatically from here, in part because even with extremely weak home sales, you've seen home price growth actually start to pick up again. And I think it was last week we saw the Case-Shiller surpass the peak that was reached last year. So I think that does support housing. So maybe this won't be, if it is a mild recession, I don't think it will be a housing-led downturn. But broader economy, I think, looks a little more challenged by these higher rates.
Which, of course, raises the question about the labor market. We get a jobs report on Friday. I sort of did a deep dive into JOLTS and ADP and why economists were brushing off both of them because they were kind of differing signals. What do you think is happening underneath in terms of the labor market and specifically on wages, which we know is so key for the Fed?
Yeah, so, I think you're right that you have to kind of look at all these figures impressionistically, and ADP certainly isn't something we'd really want to hang our hat on too much, but I think generally speaking, the labor market has been slowing, maybe not as slowing as quickly as people, ourselves included, thought at the beginning of the year, but the trend is still pretty clearly down. The revisions certainly have been consistent with that. So I think we'll continue to see that into year end is our view, and that we'll get to sub-100 payroll growth by early next year. Now, wage growth has also been decelerating, but I think some further to go there for the Fed to be comfortable switching from a tightening bias to more of a neutral bias.
So you don't think Fed Chair Powell is going to look at this report on JOLTS and say, yep, 1.5 openings for every unemployed. That's still pretty hot and pretty tight. We got to do more.
Yeah, no, I mean that
You've said that before.
Yeah, certainly. So the vacancies to unemployment rate did actually tick down a little bit in the most recent report. But it is elevated. As you said, it's 1.5. Normal might be 1 to 1.2. But we are making progress, right? That peaked around 2. So we're probably halfway on this journey to a more normal labor market. And, Powell has said they're going to be forward-looking in this respect. And look, they were on hold last month with a VU ratio, vacancy to unemployment ratio at 1.5. So I think they're going to be forward-looking here and think about where the labor market's going rather than where it is.